good afternoon or good morning or good evening, depending on where in the world you are. I'm just going to give everyone a few minutes just to log in. It is only actually 4:29, so it's a few people early, which is good. Obviously, today's seminar, or webinar, I should say, is all about the different investing trends we can look at, both for today's market and economy, but also for the future. That could be in the next 3, 6, 9 months. It could also be in the next 2, 3, 5, or even 10 years. So I'm going to look at some of these trends, and it's going to be focused around quality, innovation, disruption, and everything really that's been accelerated by what's called the new norm. This is the latest phrase that's all over the media and news, is the new norm that we now live in. So that's the agenda for today. I'll give people a little bit longer just to log in. I can see there's already 8 people in, which is great. 9, 10, 11. So it's filling fast, which is great. But I'll just give everyone a couple more minutes. Let me just go through to the next slide, actually. So, okay, well, that's me. You can see me in the video anyway, but there's my contact details, my email address and phone number. I recognize a lot of the names that have registered and a lot of the names that are online now. But of course, there's some people that I've never met or spoken to as well. So there's my contact details. We'll send you a recording of this afterwards anyway, but if you have any questions or perhaps you missed the Q&A at the end or had to go early, please feel free just to contact me and I'll get back to you from there. So that's today's agenda. Like I said, I'll give everyone a few minutes just to log in and make sure that everyone that's going to be roughly on time is going to be roughly on time. But we'll go through it quite quickly. Hopefully we'll finish early. I'd like to leave some time for Q&A. I think the last 2 webinars that I did, there's been quite a lot of questions, which is great. I probably won't look at the questions during the actual presentation, so just put them through towards the end and I'll try and cover off as many as possible. Although hopefully in these slides and as I speak, maybe I'll cover your questions as we go along anyway. So I just give people a couple minutes. It's 4:32 now, so we now have 15 online, which is great. Just give everyone a couple more minutes. Okay, so maybe rather than just staring at the agenda, perhaps what I'll do is I'll just quickly go through the couple of intro slides that I have. Like I said, I recognize a lot of the names online now and also ones that registered. In case you're new to IPP, we really cover the full range of financial services. That's everything from traditional financial planning and insurance, right through to the corporate side as well, where we do employee benefit schemes, group insurance, that sort of thing. But very much the core of what we do, and of course what this webinar is going to cover, one aspect of is the private wealth management side. So this is investing, saving, really a lot of the different aspects of financial planning ultimately come down to portfolio management. So this is really our forte. We actually currently have around $2 billion of client assets under our advice. 50,000 clients, which obviously includes just insurance clients, but you can see we're pretty big, we're pretty good at what we do, and hopefully today that will demonstrate our investment capabilities, give you some ideas, some food for thought, and hopefully can add value to whatever investing you're doing, and hopefully it's for us, of course. 2 slides here. I can't believe the disclaimer is 2 slides, but it is. I've been told this is very, very important by my compliance division, so please read through it very, very carefully. Like I said, there's actually 2 pages. I think basically, a long story short, if you go away and do your own investing based on some of the things discussed today, don't blame me. But of course, if you do and it goes very, very well, or if you do stuff through us, please feedback and please give us some credit. Like I said, hopefully today, this will just give you some ideas that you can apply, to how you invest, and some ideas to discuss with your financial advisor. And those of you that don't have a financial advisor, of course, you have my contact details. So I think it's 4:35. I want to try and keep to the schedule in case it overruns. I'd rather finish early. Look, we've said it before, the reason why you're all here, we want to talk about the future. What investing trends can we look at that can work today, but also are going to be relevant, in the future? And that could be in 3 months, 3 years, within 30 years' time. So we're going to start off with the new norm. This is obviously something that's been forced upon us, whichever country in the world you live and work in or from, we've all been subjected to some form of COVID-19 related restrictions or lockdowns, whatever it may be. And that's obviously created the new norm, a new way of life and a new way of business and doing things. And I think what this webinar will address is, how can we apply what we're going through and what these changes actually mean to us and to our investing. So just very quickly, this is Singapore. I think we're based in Singapore. A lot of the people online now are based in Singapore. We went through the circuit breaker that obviously caused the development of this new norm. Relatively under control. I think this is quite a nice graph so far anyway, touch wood, how to do it right. I don't think any of us enjoyed circuit breaker and being stuck at home the whole time, but it does seem to have worked. You can see there that the cases are very much, still with us, but very much under control and a lot better than it was. There was one point, sort of around the June, July period where it was picking up. There were obviously lots of foreign workers in the dormitories being affected. And then of course there were lots of import cases as well, but we seem to have avoided, a wave two. Wave two keeps being talked about, especially in some countries in Europe, France, Poland, Holland, Spain. They seem to be in wave two already. Belgium, Italy and the UK are really struggling. And the graph here is actually of daily cases for the United Kingdom. As you can see now, it's really gone back up to a peak level. This is higher than it was when there was a lockdown in the UK, and of course they're talking about potential second lockdown, which may or may not happen. Now, of course, I've missed off one of the biggest parts, or the biggest country, I guess, when we're talking about COVID-19 cases, and that's of course the US. America, as you can see, had a spike, kind of got it under control, has had another spike for sure, didn't really get it back under control, and perhaps now we're going to see another upward trend. It does get worrying a little bit because, in America, in a lot of the developed West as well, we've got winter coming. The traditional flu season will be upon us. And I think there's concern about how to keep economies open, but also how to control the case count. So it could be a tricky 3, 4, 5 months still to come. Anyway, I don't want to talk too much about COVID because I think we're all sick to death of discussing it and talking about it. It comes up in pretty much every conversation. So what are all these lockdowns? What does this new norm actually mean? I guess from a economic perspective, it started with a supply chain disruption in China. Then there was a demand freeze, and we're starting to see some bankruptcies. I believe that trend, unfortunately, will get bigger and bigger. But what does the new norm actually mean for us? We've got this work from home environment that seems to be working. It seems to be doable, and to one degree or another will be with us, I imagine, for the rest of our lives. Obviously, social distancing, personal hygiene, these are all good things, of course. But this is very much, what the new norm is about. And it's more around this work from home component that I want to discuss what opportunities there are today and what risks as well. So just very quickly, the economies and the stock markets. What's actually happened? So how has COVID-19 affected us all so far? Well, I think we're all quite aware that there was a pretty big crash. This chart here shows the green line is the S&P 500, which is probably the benchmark for global stocks. But the blue line is the MSCI All Country World Index, which takes into account basically developed economies and also emerging ones, and creates an index basically of global stocks. And as you can see, everything just fell. It's quite a sharp, fast fall. It is nearly 35%, it's around 33% down for both, in fact. And it's actually not the minus 33% that was scary. It was the fact, this x-axis is, just over a month. I mean, it was a quick fall for sure. Obviously, you can see it starting to rebound. And we did see a rebound because we had a lot of very fast and very big government responses from an economic perspective. I think everyone has their own opinions and ever-changing opinions on the effectiveness of how countries have managed lockdowns, social distancing rules, and the actual virus contagion itself. But from an economic perspective, governments acted very quickly and in a very big, decisive way. And that could have future ramifications for sure. But what it did do is actually create a lot of safety to the economy and to the markets in particular. I won't go through all of this. This is actually an old slide. This was from the webinar we did back in, I think, April or May when all this was happening. Obviously, there's been more stimulus packages since in pretty much every country. The US and Europe are doing huge amounts of stimulus. But also over here in Asia, you can see, just to put things into perspective, Japan's economic stimulus package was about 20% of their economic output. Same as Singapore. 19% of GDP went into stimulating the economy and supporting people. One thing I just want to highlight very quickly, and this is still true today, China actually has done relatively little so far. And that's interesting because it could mean that they have the tools to actually economically fight a second wave, or arguably they've had a second wave already. But that's interesting that they've actually done relatively little. So of course the stock surge, again, you can see the S&P 500 and the MSCI World both went up very quickly again. You can see here it's really the bottom in March right through to peak at the end of August, start of September. It's not a long time. It seemed like a long time. This year has been an extraordinary year and seems to be never ending. But time's been flying and the markets flew as well. Now, maybe we're just seeing a bit more of a correction now. And I guess the question is that going to continue back down to this level? Or are we going to see another bounce and this is just a small correction? We shall see. This is the market in sort of the big picture. So this is year to date from the start of the year in January. And again, you can see pretty much all stocks following each other. America is obviously the big story. The NASDAQ was the big story because it went to new all-time highs. And of course, has fallen quite a bit more than other markets just in the past month or so. But you can see here that there's still a positive return overall. This goes through to September. So are we at full cycle? Have we seen this? Is there more to come? I guess we'll have to wait and see. That's the big question. But one thing I did cover before, the previous webinars, for those of you that did attend it, we were very much looking at why is the economic situation so bad, yet the market keeps going up. And you can see at the bottom here, I put a big K. That's actually, I didn't coin the phrase, obviously, but it's actually quite common now. It's become a very well-used term in the last few months. And it can apply to economies or markets. And it's basically, you're going to have some that will go up, the strong get stronger, if you like, and some that are really going to fall by the wayside. And this is whether you're looking at a country or whether you're looking at a company. I think this can apply today. It has applied for the last few months, and I think it can apply actually for the foreseeable future. So that's just the K recovery. The notion that the strong will get stronger and the weak will get weaker. And that's basically what has been happening. So what actually did well last time? We saw how stocks fell, and we saw how stocks recovered and did very well. Will the same ones do well from now on? That's the big question. So just very quickly, look at some of the core strategies. We manage probably 30 odd model portfolios, and of course, lots of tailor-made portfolios for our clients. This is just a quick snapshot of some of the sort of core strategies we use. And again, I've included the MSCI All Country World Index as a barometer, if you like, for the global stock exchange. And you can see they've all done very well. Pleasingly, actually, when you look at year to date, and this goes to the end of August, so it doesn't actually include September so far, but you can see that there has been a return on money despite everything that happened in this period. But also pleasingly is probably the three key strategies on here that we use for different reasons on different platforms for different people. But they've all outperformed. Long may that continue. Obviously, we're not always going to pick the best strategies and beat the market every time, but it's pleasing to see because, like I said, this has been a very testing year. Nothing like this has ever really happened in our lifetimes, or actually through history, in fact. So it's really great to see that happen. Now, what I want to talk about today is not what's happened necessarily, and not about these core strategies, but what else can we look at in our portfolios? And I think the main thing from the title and what I've said so far, innovation. We want to be with companies that can innovate. They can move with the times, they can adapt and thrive from this new norm, from the work from home environment. And actually, you look at innovation, I've added in here, the top one. This is exactly the same chart as just now, but with A added in. A is the Guinness Global Innovators Fund. And whilst we use many different strategies to cover different parts of innovation and different sectors, this is quite a good core offering that does go across all the different areas that I'm going to discuss today. And you can see again, I don't think that's luck that it's outperformed. You can see the actual numbers here. The year-to-date number as of end of August was plus 21.82%. It's fantastic, really phenomenal. I think actually, given the year, most people were happy with 5.9%, especially as cash in the bank gives you nothing. And that's what global stocks did. So 5.9 to 21.8, that's really some significant outperformance. And like I said, I don't think it's luck. I think it's taking a lot of the quality core aspects of the other funds we were using and just adding in some of these innovative companies and ideas that we'll talk about today. So just a quick one here. You can just see here a tweet from me on May the 23rd. Again, just talking about the K recovery. I do a number of tweets and also a number of articles on LinkedIn. So if you're not following me on these platforms, please do. I don't do 20 updates a day or anything like this. Sometimes they're short snippets, sometimes they go in more depth, but hopefully you'll find a useful resource in terms of investing ideas or anything really to do with financial planning. So please do follow me if you don't already. And this was just something that we talked about again at the last webinar. And I wanted to highlight again the notion of the K recovery, because when you look at the S&P 500, if you look at ETFs are very popular now, so they're a great way of accessing the market, getting diversification. But do you really want an ETF in the S&P 500 today? You certainly didn't want it back when all this started. If you just imagine for a second, you don't know what happens, or you know that there's a pandemic, there's going to be a global lockdown, and people are going to work from home and be stuck basically in their countries, no more travel. You wouldn't really want to invest in any of these companies, let's be honest. Yet these are all components of the S&P 500. And I think that's why we need to look at not a very generic ETF or a very basic global managed strategy, but ones that do really focus on quality companies, innovation, etc. Because again, these ones, for different reasons, are clear winners. I mean, Clorox and Colgate and Johnson & Johnson, I guess they came from the Clorox do like cleaning fluids and bleaches, etc. They obviously did very, very well because everyone was stocking up on them. Everyone's doing more cleaning, personal hygiene is more important. And again, Amazon, Netflix, PayPal, Visa, you know the reasons why these have gone up. But these are exactly the types of companies that I'm talking about today that can do well again if we see a wave two. But also, these companies are exactly the companies that I think can do well for the next 3, 5, and 30 years as well. And I know 30 years is a big call and it's very hard to actually know who's going to do well and who's not in such a time frame. But hopefully today I'll explain some of the reasons why and some of the ways you can access these. So where to invest? Again, this is exactly the same slide as previous webinar, but you can see it's these quality companies. So these are all of the core strategies that I mentioned before that outperformed. A quality company has low debt, is profitable, strong balance sheet, has a competitive, sustainable competitive advantage. They use shareholder and company capital effectively and consistently well. And also, they look at ESG. ESG is important, and that can mean different things to different people. I will touch on ESG today, but I think that's a whole different long conversation. But it's certainly an opportunity, hence why I've put it across all three areas. Again, the new norm, so anything to do from work from home, online shopping, e-commerce, payment processes, the PayPals, the Visas, etc. Logistics. I mean, if we're doing a lot of e-commerce, someone needs to deliver it to us. So logistics is a side one from that. And obviously connectivity, cloud, enterprise, things like this. We're all working from home. We're viewing, a Zoom webinar from all over the world, all at the same time. This is very much the new norm. And of course, the more longer term themes, which innovation, disruption, tech and healthcare. I'll mention that a bit more later. FANG, I think we're all familiar with that now. Facebook, Apple, Amazon, Netflix, and Google. And again, these all fall under these key themes. And 5G. 5G is something that's probably a bit more immediate. It's gradually being rolled out, well, now in fact, but certainly in the next few years. And that's going to be a huge opportunity for a lot of companies. And guess what? A lot of those companies fall into this area. So it's all quite interesting that these three key sort of concepts, they all overlap. And I'll show why and how in a bit more depth soon. So just a quick reminder there, that's the core funds. And then when you add innovation in, it has really outperformed. And I do genuinely believe that that will continue. So therefore you need to avoid on the other side, everything else. Do you really want to be investing in companies with high levels of debt that don't make profit? We don't know how bad actually this economic recession is going to be. I mean, you could argue we're in recovery already actually, but this could still last and have ramifications for a number of years. Do you really want to have your money invested with companies that don't actually invest their own money well and don't have a good business model? Banks, I think there are a lot of cheap banks out there, and there will be some opportunities. There probably are some opportunities now, but I would say the US is where to look for. European banks, they haven't learned their lessons from 2008. Same sort of thing, they have no cash. They've got weak balance sheets, in fact. Dividends have stopped. Some examples, actually, they're not allowed to pay dividends, but still, I wouldn't go into these. And value. And remember what I was saying about the K recovery. Value, quite often, companies are good value for a reason. And it's maybe because they have all of these and none of the other things I was talking about before. It's really, I think you need to be careful. There are definitely opportunities with value investing. I mean, Warren Buffett, of course, is the famous value investor. He's managed to build Berkshire Hathaway to one of the biggest companies in the world. So, it does work, but I think we need to take value generally. It's actually a long-term underperformer. And I think, yes, this is the chart here. So this is from MSCI. And all you can see here, MSCI World, again, global stocks in yellow, world value in blue. That's quite a big disconnect. In fact, sorry, not quite a big, it's a huge disconnect. So again, a lot of companies are valued for a reason. So don't fall into the value trap. It really needs the right timing. While we're on the MSCI World indexes and ETFs, just to touch on the two areas that I mentioned just now, also is quality and ESG. So complete opposite to value, where it significantly underperformed. You can see here, ESG is really gradually starting to outperform on a consistent basis. And quality, again, for the longest time, has outperformed significantly. It would actually be great if there was something that combines these two. I wish there was, but for now, these are just two key factors to bear in mind. Quality companies on the one hand, and actually it kind of goes hand in hand, but ones that take ESG seriously as well. Because I think if you apply those two factors to everything we're talking about today about innovative companies, I think you've just got a winner. I find it very hard to see how those won't really outperform. So specifically, innovation, disruption, 5G, ESG. I think I've talked generically about a lot of these things. That's just the quick summary on where to invest. What does it mean actually? Because everyone talks about tech. Tech's overvalued. We had the tech bubble before. Is that going to burst? Is it the same thing again? I'm not going to say this time is different, because lots of people have said that about lots of things, and it very rarely is. What I am going to say is that times have changed, even before the work from home. I mean, you just consider 20 years ago, everyone is driving around in GMs or Fords, Nissans. Today, or gradually, more and more people are using Tesla, for example. Tesla's a tech company. Or is it an automobile maker? Or is it a battery provider? Or is it a space exploration company? It's very different. Facebook, again, is that just social media, or is that the new advertising? Twitter is the new news agency. So, I could go on and on with different examples. The bottom line is tech really is just a broad term that's actually outdated. So I want to look at, there are actually 6 on here, but there's 9 in total, 9 areas where I believe innovation and disruption in these 9 areas, which goes across different sectors and industries. So forget tech, is really going to excel, I think, not just now, not just as a result of the new norm, but actually things like 5G in the next 2 to 3 years, and everything else really is the future. So I think if you can pick these companies and these areas now, you're going to really benefit and outperform everything else. So just quickly, so the 6 here, the other 3 are there as well. So I couldn't fit them all on one slide without the text being very small. But yeah, just to go back to it quickly, you've got cloud computing. Again, I think 5 or 6 years ago, no one really knew what that meant. Of course, everyone now has Google Drive or Dropbox or iCloud or whatever it may be. But you can break it down to each part, you can break down to different areas. So you have the networking and storage, you have software and network providers, then it leads on to cybersecurity. So you can see there's all these different spin-off aspects from each one. Again, robotics, it's not just robots that are going to drive cars or work in Amazon's warehouses. It's everything. It's automation. It can be in healthcare. Again, it crosses over into biotech and medtech, genomics. You've got the 3D printing. So you can see it really goes across everything. Digital payments. Again, maybe another reason why a lot of banks are going to be losers in the future, because you have these digital banks now. I don't know if anyone uses Revolut. I mean, they're huge in the UK, and it's getting more popular in Asia. Why would you ever go to a money changer again? Why would you ever go into the bank and pay the extortionate FX rates? You just wouldn't. And this goes on to fintech, digital wallets, etc., etc. And again, AI crosses over into all of this. Data analytics, data is the new world economy, world commodity, sorry. Then you have machine learning, AVs, etc. And AVs, or autonomous vehicles, again, the overlap into electric vehicles, not just Teslas, but talking about trucking, the future of trucking in autonomous vehicles, goes down into clean energy. Traditionally, clean energy meant renewable energy like wind farms, solar power, etc. And today, those are still relevant. But actually, today, it's all about lithium batteries. And it's about these e-vehicles, electric vehicles. And again, that isn't just Tesla. There's so many sub-sectors and sub-companies that lead off that. And then the last three, online everything. So media becomes social media, streaming. I mean, we stream everything these days, whether it's watching TV, Netflix, for example, gaming. I see the new what are we on? PS4, no, PS5. Yeah, PlayStation 5 is coming out later this year. They've got two options. One's a box and one's online. It just shows how everything's changing. Again, Sony are innovating. Is everyone else? I mean, we all remember Amiga. The older people here will remember Amiga. They were the best. What happened to them? Disappeared. Nintendo arguably has disappeared, but is perhaps coming back. So again, you can look at different companies that are disrupting, like Microsoft did with the Xbox many years ago. So you can see how every single area that I'm on, there's innovative companies, there's disruptors, there's winners and there's losers. So it really, pays to try to break these down and look at all of these different areas and think about them. E-commerce, again, retail, I think it's very well known that retail shops, shopping malls, even supermarkets, they're all struggling. There's brand after brand, there's household names that we've grown up with that don't exist anymore or won't exist. And everything's on Amazon or Alibaba or Tencent or whatever it may be. There's also brand specific. A lot of brands are embracing this whole e-commerce area. Nike is a good example. Service apps. Then you go onto mobile tech. It's not just the 5G. It's not just your phone. It's a whole ecosystem of different things. And like I said, so there's a huge crossover across most of these from some tech and even some non-tech companies. And I'll give you a good example. Think about Apple for a second. So Apple is interesting because a lot of people said it was overvalued, then it fell 20%. And maybe that's a great opportunity today. Let me tell you about Apple and put it into context of all of this. We'll go back to cloud computing, because Apple's interesting also. It just overtook the FTSE 100 for total value, which is incredible, astounding, in fact. Look at Apple. Consider the cloud computing area that I mentioned, iCloud. You go on to healthcare and you look at medtech. I don't know if you saw the new iWatch. It can do ECGs. Apple actually working with hospitals and doctors' clinics to provide the technology to do ECGs, to do it faster, cheaper, with smaller devices. So they're really crossing it over into healthcare as well. Again, you go to robotics. Did you know Apple owns a number of patents for 3D printing? I didn't until very recently, actually, but they do. So it's an area that they look at as well. And they actually have a huge AI division within Apple. Again, it doesn't make the press, or it doesn't necessarily get onto all the road shows, and everyone just focuses on the new iPhone or whatever it may be. But there's a huge AI division there, all about machine learning. And I mean, like, as an example, you buy an iPad. Now everyone has pens for them. Why, when you rest your palm in it, does it not do anything? Because it can tell the difference between a palm, a finger, and a pen. And these are all the sorts of things that will be going on behind the scenes that we don't necessarily see, we don't necessarily know about. They also poached, last year, they poached Samsung's head for batteries. So again, they're going into this space. Whether they make their own batteries, who knows? But interestingly, they actually tied up a deal for, cobalt, to get cobalt directly from miners. So again, it falls into this area. Digital payments. I mean, we have the, I don't even know what it's called, Apple Wallet, is it? Anyway, yeah, whatever it is. Obviously, social media streaming, you have the App Store. You know, I can just go on and on and on. Obviously, we know all about the device and wearables. Again, they have the full ecosystem. You have the iPhone, you have the iPad, then you have AirPods to listen to things, and on the list goes. Next step will be VR, virtual reality. Again, they've made investments into that area. So I think Apple's a great example, actually, of, again, the huge crossover between all of this. Right, take a break from innovation very quickly, because the last two times we've done this, I've talked about gold, China, and ESG. How did they do, and are they still a valid investment, and how does it fit into this whole quality, innovation, disruption? You could argue China is a disruptor in itself. You could also argue ESG is, actually. So that's quite interesting to look at that. But how did they do since? So very quickly looking at ESG, it is a growing concept. If you're not familiar yet with ESG, it's environmental, social, and corporate governance. And it's becoming more and more important. And it's not a millennial thing. A lot of people think it's just millennials. It's not. It's everyone. And it is much larger. It's a much bigger concept in Europe. It's growing very quickly in America, perhaps not so much in Asia yet. But you can see, again, how is it done? Well, it's doing well. Every single metric here, apart from actually the last month, picked a bad example, it's doing better. And all the MSCI and ACWI ESG leaders does is it takes the index, so the same stocks, looks at every sector and just picks the top half based on ESG metrics. That's it, very simple. So which are the more ESG focused ones? And you can see, like I said, it's outperformed year to date, 5.8 versus 5.1. 3-year analyzed, 10.3 versus 9.5. This is becoming more and more important. And companies are learning that. And I think investors are starting to learn it as well. Gold, well, gold was quite a good one for me. I think it was the end of May, we did a webinar and I said, definitely buy it now. It was actually 1710. Definitely buy more if it goes below 1700, which it did for 4 days. And it actually went up to a high of over 2000. I mean, from a percentage perspective, you know, if you did it straight away and then sold at the high, I mean, that's 22%. That's more than double what stocks have done. So gold has done very well, and gold still has a place. It's come down in 1900. Gold still has a place. Why? Anyone see the US debate? I mean, that's one reason why. Politics. Geopolitical risk is one traditional reason why gold becomes a safe haven. Another one is inflation. Again, the Fed and the US government has very clearly stated inflation is one of their key goals for the next few years. So actually, I think gold is a great opportunity now. It's a great diversifier anyway, but I think it's a great opportunity still today, especially now it's come down a little bit. And the other one was domestic China. A lot of people are afraid of China, or don't understand it, or don't trust the country. But the bottom line is, again, how did it do? So from the end of June, from the last webinar, you can see A, B, and C. C is global stocks. B is the Shanghai A index. And A is our top pick for the domestic China strategy by Aberdeen Standard. Huge outperformance. You're talking plus 18% versus plus 8. It's fantastic. And why? It's the same key reasons, 5 reasons. The country's in better shape. It's now become used to and knows what to do in terms of COVID, in terms of you know, helping to stop contagion. It's insulated and self-reliant. It's really not that affected by global growth. Certainly nowhere near as much as it traditionally has been 10, 15 years ago. geopolitics, again, does not really affect it too much, and perhaps that's the reason it's outperformed. The other area about self-reliance, of course, is you've got this huge, affluent, growing population, and it's a young one. So there's 350 millennials estimated in China. That's more than the entire population of America. So you tell me that's not a place to invest for the future, because it most certainly is. And you have this whole consumption story. It's not a global trade-reliant country like everyone thinks it is. It's not. It's still a big part of GDP for sure, but it's not reliant. It's its domestic consumption. Domestic consumption. And that's why I like the Aberdeen Standard China A-Share Equity Fund, because it focuses on that specifically. And again, perhaps that's the reason, this is a very short time frame, but perhaps that's the reason why it's also outperformed Chinese A-shares. A-shares being domestic China, not global China, which is listed in Hong Kong. And then the last point, stimulus. You saw on my other slide that pretty much every government in the world has done everything and anything it can do. China hasn't really. So, you know, there's still the tools there, if it does get bad again, to do monetary or fiscal stimulus, in fact. So I think China's an interesting one. And either way, I think it's a good diversification allocation. And again, long term, look, it's volatile, but for the long term, like I said, 350 millennials, more than the population of America. There's no way that's not a place to be investing. So back to innovation, because that's the main topic for today. Of course, there is a lot of innovation that crosses over into China as well. We talked about Tesla as one company for e-cars. Recently, there was a company called XPeng that listed in the New York Stock Exchange, the Chinese Tesla, if you like. And I think we're all now very familiar with the likes of Alibaba, Tencent, etc. So it isn't just a US or European thing, it's a global thing. And I wanted to put this up because it does, I just remind everyone of the 9 key areas. And it really is, tech is everything and everything is tech. Just consider this for 1 second. So we'll start up here. Think about your day. And this is why tech is everywhere around us. You wake up, your alarm goes off from your iPhone. Could be a Samsung. I'm just going to give some examples. You have a load of reminders and a to-do list from Alexa, Amazon. You then grab an Uber to work. Or maybe if you're in Asia, you take a Grab. Maybe you have your own Tesla and you drive that to work. Or of course you're stuck at home. But either way, you turn on your computer. I've got a Microsoft Surface. You might have an Apple Mac. Anyway, again, these same companies that we've been talking about. You then access your files. Google Drive, could be Dropbox, could be iCloud, etc., etc. And you open up your PDFs, which is Adobe. Maybe you send them to a client that you're talking to, or Zoom, like now on a Zoom call. And they sign the documents using DocuSign. So you see all of these different companies that some existed and some thrived, but some are new and are still to thrive. You finish your work and you go and work out. You've got your iWatch or your Garmin or whatever it may be, telling you your heart rate, etc. You're streaming music on Spotify while you're working out. And then, I don't do this, but apparently some people do. You take some photos and you post on Instagram. You finish your workout, you go and buy your protein shake or your coffee or whatever it may be. Use PayWave. And again, this could be PayPal. It could be using a digital wallet like Apple Wallet or Garmin Pay, etc., etc. You go home and then you watch Netflix, or you play on your PlayStation, or you read on your iPad, or you use your Kindle. Kindle's at Amazon again. So you see these companies are all around us being used so many times. And that's another reason why 5G, which I've mentioned, is a huge opportunity, massive. Because again, it goes so much further than just telecoms. People think, oh, it's AT&T or Ericsson or Vodafone or whatever. No, I mean, yes, they will benefit from the rollout of 5G for sure, but all of these devices, all of them, you know, the new iPhone, the new Samsung, all the new phones, the new iPads, etc., the new watches, they'll need 5G technology. And there's not enough chips. So again, you look at semiconductor companies, TSM is a big one, Qualcomm as well. And the list goes on and on and on. You know, there's Qorvo, there's Skyworks. There really is so many different names. And you see how all of this beds together and all of it spreads into lots of different areas that you can invest in, from a work from home theme, from a changing to the new norm theme, from 5G, and also much further in the future, things like robotics, things like AI, etc. These things are forever going to change. And again, just go to cloud, which is one of the big things that I think will benefit from the work from home, is companies will spend on their enterprise software and their systems and their security. Well, the biggest players in cloud are Azure and AWS. Azure is Microsoft, AWS is Amazon. So you see, we think that Amazon's just somewhere you go to, buy a Christmas present. Microsoft just does Office, but it's not. And actually they're in these growth areas because they have innovated. And that's where it becomes interesting. And that's why tech is all around us, and whether we like it or not, and whether we're good at tech or not, we're doing it. And right now is the perfect example. We're on a Zoom call with 50 odd people in 5 or 6 different countries, from what I can tell. So just on disruption, obviously there's lots of talk about Uber. Uber was a famous disruption. Does that make it a good place to invest? Actually, not necessarily. So, and I'm not saying invest in any of these companies per se, although I do hold shares in all of these apart from 3. You can look on my website to find out which ones. But you also want to avoid being disrupted. And I think the classic example is Netflix. Netflix was the disruptor. How many people can remember Blockbuster Video? I mean, yeah, they got disrupted big time, and they did not innovate. That's the key. They weren't a quality company, they didn't have a strong balance sheet, and they did not innovate. They did not do it. They now don't exist. Netflix is a multi-billion-dollar company. So yeah, make sure you're picking the disruptors, not the disrupted. And just conscious of time, because it's 15 minutes, so I want to try and leave some time for Q&A. Do you invest today though? I guess it's all very well talking about these themes and these companies sound good, but they're so expensive, right? Apple was crazy valuations. Well, it's fallen 20% since then, so maybe it is a good time to invest. But also just forgetting about companies, forget about countries even, and sectors. For me, there's only 2 things. Do you invest or do you not invest? And I think the reasons to not invest, there's only 2 reasons. You need the money for something soon. Soon being next week, next month, maybe in a few months' time. At least 12 months anyway. Or, and this still is not actually necessarily a reason not to invest, you're retiring soon, or you're already financially independent. Now you still need to consider investing, but it's a reason potentially not to. Otherwise you must. If you've got money that you don't need in the short term, you've got to do it. Okay, we've got these 2, well, you all have financial goals, I'm sure, but you've got these 2 areas here. Low stroke negative interest rates. Yes, parts of Europe do have negative rates and probably will do. And inflation. These are 2 massive things, and I'll just summarize it here. Interest rates and inflation, and also stimulus, because no matter what happens, the stimulus is still happening. It still will happen. I know there's lots of debates in the US Senate and part of the presidential election campaigns about how much and how to spend it, but there is still stimulus, and there still will be stimulus. And you can't underestimate the effect. We saw that effect in March. What happened? Stocks soared. But the 2 biggest things are interest rates and inflation. The bottom line is, for at least, well, the Fed's talking about a 36-month time horizon, at least, and it could be longer. But if inflation is being targeted and interest rates are 0, that means your money in the bank is guaranteed to lose money every single year. Guaranteed. And that's why it goes back to actually, if you are financially independent or you're retired, you still need to invest, because otherwise your value of money is corroding every single year. And should you invest in stocks? Of course. TINA is the new one. We all love an acronym, right? There is no alternative. There's not. You're going to buy a government bond for 20 years and get 1.5% return. Inflation target's 2%. So again, guaranteed to lose 0.5% per annum for 20 years. It just doesn't make any sense. You have to invest in stocks. And what I wanted to get across today is hopefully some ideas of, what to think about, which stocks to look at and which companies and sectors. And it doesn't need to just be the US, or it doesn't just need to be China. Diversify, but keep these themes in mind. And again, don't think about tech. The tech bubble last time, it's happening again. Valuations are too hot. It's all good and well looking at valuations. Most people for valuations look at price to earnings ratios, okay? But if earnings keep going up and up and up because these small collection of companies have or are innovating and disrupting, well, then their earnings are going to increase year on year as well. But also, what's it relative to? When I moved to Singapore in 2006, I could get 5.5% return on a 1-year fixed deposit. If you did it for 3 or 4 years, you get 6 or 6.5%. We're not going to see that in our lifetime. Our children won't see that in their lifetimes. Yes, I don't think we're going to be at 0 rates forever, but they're not going to go up anytime soon. So you need to put the so-called valuation of stocks into perspective, because there is no alternative, at least for the next few years. So now it's a case of just trying to find the right ones and the right ways of investing and at the right time. And the time is now, and it will be next week, it will be next month, and it will be next year. We've got, at a minimum, we know the Fed timeline is 36 months. I think it'll be longer. Even if, there's political instability in the meantime with the US elections, the US-China trade wars, etc., there'll be hiccups. There will be actually opportunities. And I would say any form of consolidation, which arguably could be what we're seeing right now, is an opportunity to add to your investments. It's certainly something to think about. Now, I've got lots of slides on why to invest now, why to stay invested, should you invest on a regular weekly or monthly basis, or just do it in tranches. And I can go through all of that. But what I think would be better, it's 5:22 now, is ask me some questions. You can ask me anything on anything we've talked about today. I should be able to find the questions on here, if anyone wants to post any. But also, you can send me an email. If you don't have my contact details already, just pop me an email. I can talk about anything that we talked about today, quality, and obviously the innovation disruptors, but we have funds and ETFs that can access all of these different areas. There's even an ETF on the whole battery and electric vehicle sector. So it can really go quite specific. There's a fund on AI now. There's lots of different ways to access all of these. So yeah, just let me know either now or via email. Okay, so we've actually had a question. How will the US election affect markets and the trade war? It's a good question. Well, you could say that the trade war is all Trump. And of course, if you watch the news, it seems to be. And yes, he hasn't helped it subside at all. But firstly, this isn't a trade war. It's a currency war. And this started before Trump. It started before Obama. It's been going on for 20 years, and it will go on for at least another, I would have said 20 years a couple of years ago, at least another 10 years anyway. But in the more short term, of course, we all know Trump is very anti-China, very publicly anti-China. So I imagine that if he remains in power, if he gets re-elected, this trade war rhetoric will resume. I think it's been toned down a lot recently because of coronavirus, because of, economies. But yeah, if Trump's got a whole nother term to play with, he'll definitely reignite the whole trade war. In terms of a market perspective, I guess the simplistic view would be Trump is positive for markets, Biden not. But actually, I think if Biden gets in, it's not necessarily negative for markets. After all, don't forget, right now, if you believe the opinion polls anyway, he was winning. He was winning before the debate, and he was winning by even more after the debate, which was shockingly entertaining. If you haven't seen it, try and find it on YouTube. Very classic American politics. But I don't necessarily think actually a Biden election is going to be disastrous for stocks. Like I said, we'll still have some stimulus. Of course, the president doesn't have as much power as everyone thinks. A lot of stuff is done by the Senate. But also, and again, how you exactly measure this, I don't know. But JP Morgan, and I'll try and find this document for anyone that's interested. JP Morgan did a study of the stock market and US presidential elections going back to the 1930s, and apparently past a 6-month view, the actual effect on markets is negligible. I'll send that out to everyone and try and find it. I don't have it open, or I could share the screen if I knew where it was. But what I would say with the election is it's going to create this volatility. The volatility we've seen in the last month, and also the volatility we will see. There's also, strangely, I didn't know this, but there's very little chance we will actually know the winner, the actual outcome on November the 3rd. It's down to the postal voting system and counting and checking, etc. Again, if that is a prolonged period, if it ends up being days or even weeks, that will add to uncertainty and volatility as well. So I think it's actually more the run-up, it's more now. I think we'll see the US election creating volatility. Okay, we've got another question just come in. How would the large global tech firms be impacted from an increased tech Cold War stance, and some of these companies might be pushed out of certain markets? Do you see this as a real risk that could re-rate some of these companies? Yes. Yeah, I mean, of course, there's always such external risks. Again, politics can come into it as well. There's been lots of this TikTok chatter as well. I think at the end of the day, whoever's asked this question has said it right. When you look at a global tech firm, it's not just global in terms of the offering or the headquarters, but nowadays it's global in terms of the listing. And I guess part of the wider currency war, stroke trade war, whatever you want to call it, is you're going to see more and more companies that, to give the example, maybe are listed in China, are Chinese listed in the US, but you're going to see more and more listings in China as well. And Hong Kong in particular have been very keen to increase the number of listings available. I think we've all read about the, what's it called? Ant IPO, which I think is Tencent, the financial services app. I mean, that's going to be a record-breaking IPO, and that's happening in China, not in the US or Europe. The company I mentioned just now, XPEV, Chinese e-cars, they listed on the New York Stock Exchange 4 weeks ago, very recently. So there's absolutely a risk for sure, but I think global really is global these days. And I think that, again, it goes back to, if these tech companies are innovative, of course, by nature, tech companies should be innovative, but if they're innovative to their market and they're doing things in the right way, that can continue. And I think, you know, you can just look at Apple. I'll always go back to Apple because I know a lot about them. I've owned the stock for a long time, but Apple's really not frozen out of China is the wrong word, but there's a huge emphasis on trying to make Huawei destroy Apple in China. Yet Apple still makes inroads. I can still remember, I mean, this is going back 4 or 5 years. I used to go to Hong Kong every month, and I'd see people queuing outside the Apple store every day, not because there was a new iPhone being released, but they were buying as many as they could, taking a train across to China and selling them for double the price. Now, of course, that benefits them probably more than Apple, but again, it gives you an example that I think they will continue to have all these political challenges and hurdles. But again, if you pick the right companies that have what I've just said before, the strong balance sheets, money to invest in the right way, and do innovate and disrupt, these will be the winners, and external factors may affect them, but I don't think so. Alibaba, when it first IPO'd in the US, there was lots of talk about you can't trust Chinese companies, lots of talk about the US banning a lot of their products, almost, I think it was the day of, or certainly the week that it listed. Of course, it's worth 4 or 5 times that value now. So yeah, there's always a risk. And I think tech Cold War stance is interesting because of things like TikTok recently. It's made the news a lot, but yeah, as with everything, there's a risk. But I think these areas that I've highlighted today is certainly what I believe will really be not just the outperformance from the last 6 months. I think there'll be the outperformance for the next 6 months and for the next 6 years. So. Okay, so there's still 15 people online. Any more questions? Of course, 5:30 exactly. I normally talk well over the end. Any more questions, pop them in. I'll maybe wait 1 more minute. Otherwise, I do have some more slides, but I don't necessarily want to keep you all online. I think one thing that could be quite interesting about the whole sort of what do you call it? Why now is this one. So stay invested. It goes back to the tech bubble and obviously the bursting of it, and the global financial crisis. And it's just interesting. It's about, you know, why you should stay invested, because the person that invested here went through the 2 big recessions and crashes. Actually today has more money. This is pre-corona crash, but actually has more money, a lot more money than the person that started investing after the recession in 2009. That's quite interesting. And again, it comes back to the timing of recessions and markets. Economies are backwards looking, markets are forwards looking. And again, it comes back to why to invest today. It would have been interesting to start the line here, actually. Not that I think we're there today, but that would be interesting. But I mean, looking at it graphically, I don't think there's going to be much difference. I mean, again, the market's considerably higher up. So anyway, just some food for thought. Okay, any more questions? No. Okay, well, thank you very much, everyone. Like I said, we've used Microsoft Surface, Zoom, an Apple iPhone, and whatever else you guys are using today. So like I said, it is all around us. Just because something's popular doesn't necessarily make it worth buying though. That's one thing I would leave you with. I use Netflix as a good example. Netflix obviously was a huge benefactor from the lockdowns. We're not going to see another global lockdown of the same nature, I don't think. Or I certainly hope not. So that could be a good example. Has that already been priced in? Where do they grow from here? Will people actually cancel subscriptions? Again, just think about things, not just because they're popular, but think about what prospects are for the future, and think about, you know, what could happen in the short term as well. So have a think about that. Let me know any questions. Like I said, and if I haven't made it clear enough, I really genuinely believe that today, as is tomorrow, as was yesterday, is a great time to invest. You just got to invest in the right places and in the right way. Okay, thank you, everyone. Wish you a good evening or day. Thanks.